What's up everybody, Yasin here and thank you for joining my channel. In this video, I'm going to cover a very important topic, which is how the banking system has completely changed since GFC. What is GFC? It's the global financial crisis that happened in 2007 and 2008. Before GFC, the banking system was used to be a little bit different than what we have today. So I'm going to make two videos. Part one is this one where I'm going to cover the pre-GFC scenario, and then part two where I'm going to put the link down below, which I will cover the post GFC scenario. So stay tuned till the end. Don't forget to subscribe. I'm going to post both videos in the next 2 or 3 days, so you will get a lot of intelligence out of it. So without further ado, let's dive in. Alright, so this is the illustration of the pre-GFC banking system. Pre-GFC means before the global financial crisis that occurred in 2008 and 2009, when the JP Morgan went bankrupt and they did not have enough money to operate themselves. Hence, they went bankrupt and it actually collapsed the entire financial system. Now, what has changed? I will cover this in the next part of the video, but in this video, I'm going to cover how the banks used to work before GFC. Okay, so just stay with me. I'll try my best to explain. So what we have here is the central bank of the country. They are the issuer of the currency, right? So they issue currency, and the way they issue currency is, of course, by multiple methods. I'm going to cover only two methods here, which are very focused. So they purchase government's securities. So government issue bonds. Okay, these are treasury bonds. 5 years, 10 years, 30 years treasury bonds. Government issue these bonds. The central bank, they purchases these bonds from the government, and in return, they credit government's account with newly created dollars. So in the balance sheet, you have assets and then you have liabilities. Assets where the central bank purchases these securities from government and they credit the newly printed money or newly created dollars into the liabilities section. And basically this is a reserve account that the government and the central bank maintain with central banks. Commercial bank maintain the central bank in order to operate. So that's how the central bank purchases government securities and credit the newly printed money into their account within central bank. Now, the way commercial banks work, they also have the balance sheet, assets and liabilities. Each commercial bank must maintain a limited amount of funding in their reserve account with the central bank. That's a part of the requirement as a regulatory that each commercial bank must maintain the limited amount of funds in their reserve account. And what they do, they have loans and mortgage-backed securities that central bank also purchases, and in return they create newly printed money and credit this into the commercial bank's account with central bank. So the central bank actually prints money in two fashions. Number one, they purchase government securities, and in return they create new money that goes into the government's account in central bank. And then the commercial bank also sell securities like mortgage-backed securities that also central bank purchases and print new money and credit that into their reserve account. Now, the BR here shows the bank reserve, and this 2.0% is the overnight rate. So the interest rate that you hear in the news, this is basically the overnight rate or funds rate or whatever they call them that central bank actually set as part of their monetary policy. And this is a rate that these banks charge each other when they lend money to each other. So what happens is, they have to keep a limited amount of funds in order to operate themselves each day, each night. And when they have excess amount of funds, they then lend this out into the other banks in the money market or called repo market, and they charge 2% the interest rate set by central bank as the overnight rate. So the banks lend to each other as well. They charge the same amount of interest rate that the rate set by central bank in order to make money. The other way for commercial banks to make money is to lend money to the consumers, every Joe and Jane, and they also collect deposits from the consumers, and in return they used to pay interest on those deposits. Let's say it's 1.8%. So that interest that they are paying to the consumer must always be lower than overnight rate. So that's how they make money. So whatever the rate that is being charged by the central bank, they pass on a smaller amount of rate in terms of interest to the consumer. So you see, in order to collect deposit, these banks used to compete with each other to collect as much deposit as they can, because that will increase their lending capacity. So whenever a consumer deposits the money, it goes into their liability section, and in order to create the banking reserve to increase the capacity, they have to either capture as much deposit as they can or get more bank reserves from the central bank by selling mortgage-backed securities. So that's how it used to run in pre-GFC scenario. So the banks, I'm going to summarize this again. So central bank purchase government securities. In return, they create newly printed money into government's account, and government can use that money to do like fiscal spending and whatever they want to fund. They can use this money to do some other projects. Similarly, commercial banks, they also sell their mortgage-backed securities and other bonds to the central bank, and so the central bank can create the newly printed money and credit into commercial bank's account in the assets section. So that increase their bank reserve amount, which means that increase their lending capacity to lend more, to issue more loan into the economy, right? And the rate that they charge with each other in terms of lending the money, it's called overnight rate, and the rate that they set to pay interest to the consumer in return of the deposit is always lower than the overnight rate. So that used to work. That was a system that used to work pre-GFC. Okay, and you can see here the money creation was somewhat limited. The central bank can only purchase the available bonds in the market, and in return they can create this new money. And the central banks can also issue the loans as long as they have the capacity to issue new loans, right? So that capacity is measured by the amount of deposits as well as the bank reserve that they have from central bank. So that was the system before GFC. This whole system is completely changed after GFC, and I'm going to cover this in my next video. So please subscribe and watch that next video as soon as I post them. Thank you very much.